Welcome to the latest edition of Structured Finance Conversations. I'm Susanne Matern, head of EMEA Structured Finance, and today I'm joined by Daniel York and Varun Sugathen from our EMEA CMBS team. And we are going to discuss the trends we see in the CMBS market. So welcome, Daniel. Welcome, Varun. And maybe we start with you, Daniel. Maybe you could provide us with an overview about the state of the market.
Certainly. Commercial real estate has been through a period of turbulence, really. Now at a reasonable level of calm, and I think there's investors' confidence that's a bit more buoyant. Access to funding is more prevalent. We've also seen a welcome return of CMBS in Europe with 11 transactions so far this year, and hopefully more to come. Last year, 2021, also saw a resurgence in CMBS, although that was a little bit more short-lived. The tricky aspect for today's loans really is in relation to getting adequate interest coverage. And that means that investors and originators have to either look at secondary portfolios, those assets that are higher yielding, or put in place off-market interest rate hedging. Most of the transactions we're seeing are still industrial portfolios, or possibly portfolios that have a mixture of that's heavily weighted towards industrial. And we are seeing a broader aspect of various locations and property types as well, and possibly the re-emergence of retail CMBS. All in all, I think really we are seeing a more sustainable growth for CMBS in Europe. And I think with investors and originators seeing a wider range of borrowers, that should hopefully make it more robust as well in the future. With the growth of new sectors, data centers for one of them, or probably the main one really, then 2025 we expect to continue to be strong for issuance volumes and going on into 2026 as well.
Thank you. Now let's go into the subsectors, Varun, and let's think about office, retail, industrial. What changes have you seen over the past years, and where do you see the largest risks?
Yeah, I think we could start on offices. Offices is the only sector which we still have on a negative outlook, and there's a couple main reasons for this. A lot of the existing stock will need to be retrofitted to meet tenant demands, whether this is better green credentials or improved amenities in the properties. The other reason is that this capex spending is occurring at a time when demand can be quite uncertain depending on where the property is located. And that means there could be pockets of obsolescence risk across the sector. We think the best-in-class properties will continue to do well. There's strong demand and supply is still tight, and we've seen rents increase over the last couple of years. And more recently, what we've seen is some of that demand started spilling over into near-prime properties, such as in Canary Wharf, where rents haven't risen as quickly. On the other end of the spectrum, secondary properties located in not-so-good locations, which also have large capex needs, are probably most at risk from large falls in value. A couple examples of this are in River Green CMBS, where the loan is secured on a large office property in a secondary location in Paris, with most of the income coming from one tenant, which has now got into financial difficulty. That property has now lost about 60% of its value, and its reported vacant possession value is about 10% of what it was at closing. Another example is the Square, which is a large office located near Frankfurt Airport. The appeal of that location has fallen away as business travel hasn't rebounded post-pandemic, and the largest tenant has also indicated they're moving to the city centre. And again, that property has seen large falls in value. And I think overall with office, it will take some time for the change in tenant demands to feed through to the market. Tenants have historically been on long leases, and companies are still figuring out their space requirements for the long term, and that will still feed through into the market over the next few years. Retail is quite different. That had a sharp correction post-pandemic. Rents fell and values fell as well quite sharply. We are seeing a recovery now, driven by those lower rents and also the increasing cost of online retailing. But the recovery has been focused towards the prime end of the market. And what we're seeing is retailers increasingly want to be in these destination shopping centres where there's a good tenant mix, high footfall, and where they can confidently invest in their stores to create that customer shopping experience they want. And what investors are seeing is that rents in these locations have started to rise. Footfall is good, and the tenant mix is strong as well. Some of the weaker retailers have exited the market. And most importantly, there's also been a few transactions which have demonstrated pricing in the sector. For this reason, we have retail on a stable outlook. And lastly, coming on to industrial, which has probably been the most stable sector over the last couple of years. Yields have stabilized after rising from all-time lows, and rents have also continued to climb steadily after rising quickly over the last few years. We have the sector on a stable outlook, and it still remains a popular sector for CMBS.
Okay, thank you. And maybe leaving data centers to the side for now, do you see investor interest in any other subsectors?
Yeah, residential has been seeing increasing investor interest. Usually in CMBS, we see this in the form of multifamily housing, which is blocks of apartments. But now we're seeing interest in a few other sectors, such as affordable housing, shared ownership, and single-family rentals. How we analyze these subsectors would be based on our PMRP criteria, but we'll try and reflect the nuances of each asset class. For example, affordable housing would expect it to have lower rates of vacancy, and single-family rentals, in comparison to multifamily housing, can be sold off piecemeal as well.
Yeah, thank you, Varun. Now maybe we have to discuss data centers. There's a lot of investor interest about the sector. So how do you see the sector?
Well, global demand for data centers has been rising rapidly, driven by widespread adoption of AI and cloud computing. And I don't think we see that changing in the next few decades, really. The limited supply of power, limited supply of water and land supports prime locations. And actually, with rising construction costs, has led to surging valuations as well. There are risks with existing assets, however, and that's mainly due to uncertainty with technological change, power generation and chip technology being the main ones. What this means is they can have a much larger effect on these sort of data centers than other asset types, because the mechanical, electrical and plumbing equipment equates a much larger proportion of value. The rapid innovation of new tech could actually mean that existing power and cooling systems in data centers it becomes incompatible or outdated, meaning that really the important or key parameter for us to look at is depreciation or technological obsolescence. Furthermore, I suppose the useful life of the actual in-place tech as well, that matters, because eventually you're going to need to fully replace all of the innards, really, and that can have a very large cost to it.
Yes, thank you very much, Daniel, and thank you, Varun, for your insights and for joining us today. And if you have any questions or would like to continue the discussion, please send us a note to the address on the screen. Thanks for watching.